Hello, good afternoon or good evening, everyone. TJ is here, the dividend expert, and then I will talk a bit about quality investing as well. I will wait 5 seconds maybe for everyone to come in, and then we will start right away. By the way, on the right hand of your laptop or of your screen right now, if everything went right, you can see a chat function and a Q&A function. So if you have questions, feel free to ask them to us because we're here right now, and hopefully we will have a wonderful hour and learn you something new. And by the way, I'm also curious. I see 60 people are in here right now, and more people are coming in. It's interesting to see where you guys are all from. I'm not sure where it's more US based, Belgium based. Feel free to let us know in the chat, and I need to enable the public chats, which happened now, so you can do that. So feel free to use the question mark, and we will make it as interactive as possible. Gabriel said I'm from Romania, Sweden, Arizona, US, Florida, Canada, China, Poland, the Netherlands, Texas, UK, Netherlands. So wide diversification here, which is cool. And the topic of today, and I will let TJ do the majority of the talking today, but TJ and I will talk about, well, should you invest in quality stocks, or dividend stocks, or both? And this is by far the most important slide of this presentation. I'm just kidding. Just a short disclaimer. It just means, well, what we are talking about, it's just information. Feel you need to make your own investment decisions. So this is just for fun only, and we will have a lot of fun. So quick introduction about myself, but I don't think I'm that interesting. Just I'm doing the compounding quality thing. My name is Pieter, living in Belgium, and so writing about quality investing for around 1 million people. But the most important person in this call today is TJ, and he will present himself on the next slide. And if everything goes right, I also start a poll right now, which you can vote already, and then you can introduce yourself, TJ.
All right, so I'm TJ. I'm a self-taught investor. I do compounding dividends, and I invest in stocks the exact same way I'd invest in a local business. So we look at, is it a good business? Does it make money? Is it going to keep making money? And how much money can we get out of the business? So we want paid to own the business. A little bit about me: I started writing on compounding dividends August of last year to provide dividend investors with quality content. Pieter and I kind of noticed there was kind of a gap there. There were some questions being asked about dividends and compounding quality, and we kind of looked for a service we liked that maybe we could refer people to, or that would answer those questions for them, and we didn't really find one, so we started our own.
Okay, that's great. Let's see. And you can still see the slides. This is a picture we took in Omaha, and I saw Warren Buffett, I saw Bill Gates, I saw Ajit from the insurance segment of Berkshire Hathaway. But the most important person I met for the first time physically was TJ. So we took a picture here. Honest confession, I think maybe not the case for you, TJ, but for me, I was a bit drunk when the picture was taken. But we had an amazing time there. And you see the poll. I think 60% already knows you, TJ. 40% or 39% says they don't. So this is an amazing opportunity to get to know each other a bit better, because people know that, well, for me, I'm more in the quality investing camp, but it's really important to understand and to know that there are multiple roads that lead to Rome, or multiple roads that lead to heaven. In other words, every person is unique, every investor is unique, and it's really important to fit your own needs. When you feel more comfortable with quality investing, please go for quality investing. But if you feel more comfortable with dividend investing, go for dividend investing. And that's also what you see here on the left hand of the slides. The left chart, you see that quality outperforms on the long term. So it's a strategy that works. But also a strategy that definitely works is dividend investing. So you see the lines there, and when you invest in dividend growers, which is exactly what TJ does, well, it's also a strategy that massively outperforms. And it's probably interesting for people who might be getting closer to retirement, because then you also get paid a cash dividend every single month or every single quarter, and that can be very interesting. So the goal of today is that we will talk about a bit about quality investing versus dividend investing. What's the difference, and why should you pick one strategy or the other, which is the right strategy. We will also talk about how you can find dividend stocks, how you can find quality stocks, and we also prepared our three favorite stocks. So TJ prepared his three favorite stocks, and I did as well. So hopefully that will be a lot of fun. And by the way, we will keep the last 10 minutes, 15 minutes maybe for questions. So feel free to use the Q&A function. To start with the goals of compounding quality and compounding dividends, well, I will do the quality part and TJ will do the dividend part. Quality investing is all about investing in the best companies in the world. So in other words, as Warren Buffett said, well, you see Warren Buffett here, by the way, and then Charlie Munger on the other side. As Warren Buffett said, well, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So that's where quality investing is all about. You do that via three easy steps. One, buy wonderful companies. Two, led by outstanding managers. And then three, trading at fair valuation levels. So that's the essence of quality investing. It's all about investing in the best companies in the world. And then you can ask yourself, well, is it a strategy that works? Short answer is yes, it works. So if you look at the MSCI World Quality Index, for example, well, an outperformance of 3.5% per year on average. The White Moat Index of Morningstar, outperformance of 4.2% per year on average. And then obviously we also have our own investable universe, and that this universe is doing 6% better on average. One step further, essence of quality investing. Yes, it's a strategy that works. Third step is, how are you going to find those companies? Well, we always use those 6 essential steps. I won't go over them all today because I want to give plenty of time to TJ. But if you want to dig deeper into this, I think when you Google or YouTube search for compounding quality, you will find a lot. So that's the essence in a nutshell of quality investing. And then we've arrived at dividend investing. And I will leave that to you, TJ.
All right. So the goal of dividend investing is really to build a growing income stream by owning great businesses. So even though we're looking for that income, we don't discount the quality. And how do we do that? Well, we own great businesses, we collect our share of the profits, and that helps us grow our wealth. And I think when we think about this, we need to go back to the goal of growing that income stream. And if you think about that, that means the business also has to grow its profits, right? If it's going to pay you more every single year, then it has to make more money every single year. And that means that the stock price should also grow. So this isn't a strategy that only looks at income. We also consider some of that growth. And part of what I really like about this is the simplicity. So here's a quote from Joel Greenblatt. If you don't know Joel Greenblatt, he ran a hedge fund from the mid 80s into the mid 90s, and he put up something like 40 or 50% returns every year. And what he said was all of the investment philosophies for his funds are simple, they're straightforward, and they're consistent. So these are all points from Joel. Number one is you don't need the optimal strategy. You need a sensible strategy that's good enough to meet your financial goals. Number two, your strategy needs to be logical, because every strategy is going to underperform at some point. Nothing works all of the time. So if it makes sense and it's logical, it's a lot easier to stick with it when things get tough. And number three, you can be a rich and successful investor without attempting to beat the market. So that doesn't necessarily have to be the goal. And if you think about why most people are investing, it's for retirement, right? We want to make some money so that we have something to live off of when we quit working. And that's one of the things I really like about dividend investing.
Okay, great. And in the meantime, I just launched another poll. Which stocks do you prefer? Quality stocks, dividend stocks, or both? So you can answer that one as well. As more interactive we can keep this, the better. So the next question we prepared for you is, we just talked about the essence of quality investing, the essence of dividend investing. Well, next question you might have is, who's compounding quality for? Who's compounding dividends for? I think, and by the way, in the interactions, majority of people voted for, I prefer both quality stocks and dividend stocks. So I think that's an essential truth. There's room for both, and there's no magic solution or no one-stop solution. So for example, using a combination of dividend stocks and quality stocks, that might be a very viable strategy. So if we look at quality investing on this slide, well, we see with quality investing, we are more looking for an increase of the stock price, more looking for long-term capital gains to hopefully outperform the market in the long term. But I think TJ also has the goal to outperform in the long term. And it's not to get the get rich quick scheme or to get regular cash dividend, regular cash payments from your portfolio. So on the right hand slide, you see the performance of the portfolio so far since inception, October 2023. And there you see that the performance has been quite attractive. And we're also very comfortable to say that we can keep outperforming. Why? Well, you can see that on this slide. So if you look at the balance sheet, if you look at the capital intensity, the profitability, the growth, historical growth, as well as the outlook, well, you see that the portfolio consists of way better businesses. So it scores better than the S&P 500 on every metric. And then you would think, when that is the case, well, in that case, our portfolio should be way more expensive than the market, right? But that doesn't seem to be the case, because, well, we trade at a forward P of 22.7 versus 22.6 for the market. In other words, you have a portfolio that is fundamentally better, but is not trading at richer valuation levels. And from that perspective, I think it makes complete sense, rationally seen, that in the long term, the portfolio should do well. But I think the same is true for the dividend portfolio, isn't it, TJ?
Yeah, I think so, Pieter. So who's it for? It's really for investors who want a passive income stream and people that want to build a growing income stream that doesn't rely on the ups and downs of the market. So same thing, you're not going to get rich quick with it. We may not outperform the market every single year, but as you saw on the slide earlier, that those dividend growth companies do tend to outperform and do very well over time. And I think, go back to that Greenblatt point about your strategy being good enough to meet your goals, and really ask what you're investing for. Is it to maximize returns? Is it to beat the market? And like I said, most people, the answer is it's so that at some point you can quit working and live off your portfolio. And if you have a consistent passive income stream from steady dividend paying companies, then you can do that. And the market doesn't matter anymore. You can go play golf or go on holiday or spend time with your family, and you don't have to worry about what the stock prices are doing. So the other point that I really like about this is that as you get to retirement, if you don't have income coming from your portfolio, the way to make money to actually be able to spend it is to start selling down the ownership that you've built up for years in these great businesses. And that's not something necessarily that I like the idea of doing. If I own a business that's doing well and growing and going to continue to make money in the future, I don't really like the idea of being forced to sell so that I can, pay my mortgage or go on holiday.
Yeah, that's a great point. And I think also, when you just to add for you, TJ, on this slide on the right hand on the chart, you see that the dividends are increasing year after year, and that just this trend will continue. So that's the beautiful thing about the dividend growth stocks as well. Every single year, no matter what happens to the stock market, no matter whether the stock market crashes, if those businesses are healthy and they keep increasing their dividends, you will just receive more cash year after year. And that's a bit the goal of the compounding dividends and the entire strategy behind there. If we, by the way, look at the results of the poll, in the end, 74% of people said they prefer both quality and both dividends. Well, it's great that you are here in that case, because that's exactly what we will cover and are covering right now. So it's great to see that, there's room for both strategies for most investors. If we look at the performance, well, already briefly highlighted it, but here you see the orange line, which is a quality index, versus the gray line, which is a regular index. And there you see that indeed quality since 1994 outperformed the market by an attractive margin. And you see exactly the same on the next slide with wide moat companies. So companies with a wide moat, companies with a sustainable competitive advantage, they tend to do better than the market on its own. So I would also say, well, for quality stocks, the moat or the competitive advantage is the most important thing. So we will never invest in a company when we don't think it has a moat. That's really the essence of quality investing. And yeah, for the portfolio right now, there are 16 companies in the portfolio. And I would also say, well, every single one of them has a moat. And when they don't anymore, it's a reason to sell. So what we are trying to do is we are trying to combine different metrics that on their own outperform the market. And by combining them, you are trying to create a winning portfolio. So that's the story for quality investing. And yeah, what's the case in dividend investing, TJ?
Yeah, so over a long period of time, dividends really fuel compounding. So this is an interesting slide. So that kind of dark orange line is the S&P 500 price only. So this is no dividends, just the price of the S&P 500, compared to the kind of that big blue mountain would be the S&P index total return. So that includes dividends, and it assumes that you reinvested them the whole time. So you can see, at first it doesn't look like much, and then like any compound interest chart, the longer it goes, the more the compounding really fuels on itself and grows and grows. So you can see you get a massive difference between the two, and that's just from reinvesting your dividends and from those payouts that you get from the S&P 500. And I think the interesting thing to point out here is that the S&P 500 has not historically, at least recently, been a very high yielding index. It's below 2% for most of the last few decades. And if we go back earlier where this chart started, in the 60s, 70s, 80s, it was yielding a higher yield than that, but recently it has not been, and those dividends are still a really important component. If we move on, this is the dividend growers. This compares kind of different dividend policies. So the very top line, that's your dividend growers and initiators. The next one down is just dividend payers in general. Below that, we have an equal weighted S&P 500. Below that, there's no change in dividend policy. And then we get the companies that don't pay a dividend, or the ones that cut or eliminate their dividends over this time period. And again, you can see big outperformance from those companies that start and grow a dividend. And if you really think about this, again, this makes sense. You have to generate and grow more cash flow, which not only would allow you to return more and more to shareholders through dividends, but it also gives you capital to buy back shares, to pay down debt. And it's an indication that that business has some kind of moat. Because if you can keep growing and making more and more profits over time, that means that there's an underlying business there that's solid and that's doing well. So it makes sense that these companies would outperform, I think. A few more benefits. Dividends add some stability to your portfolio. So this compares the S&P 1500, so that's a larger index than the 500, in an average down month on the left and the 15 worst months in history on the right. And so the kind of teal bar is going to be the dividend aristocrats. So you can think of these as companies that have grown their dividends over a long period of time, 25 years in that case. The orange bar in the middle is your high dividend payers. And you can see even in an average down month, they do better than the purple bar, which is the S&P composite, the broader index. The only place where the high dividend yielders get into trouble is kind of that worst 15 months in history, and that's kind of the doomsday scenario. But even there, you can see that the dividend growers don't fall as much as the whole index. There's more than a 2% difference there. And this is one of those things that I think I probably undervalued earlier in my investment journey. But if you look at, there's a lot of data that the average investor underperforms. Even passive investors will underperform whatever they're passively invested in. And the reason for that is because they buy and sell at the wrong times, right? When things are going up, they get excited, they buy more when it's expensive. And one of the worst mistakes you can make is selling at the bottom. And if you think about a dividend paying company, if number one, your portfolio is not falling as far as the rest of the market, you may not panic as much. And number two, if you have that income coming in, you don't want to sell that stock, especially if you've held it for a while, because that income's probably grown. It's probably paying you a nice amount of cash. So it makes it a lot easier to behave well and to do the right thing, even when your brain's panicking and screaming at you that you should sell. This emotional benefit that these provide, I think, is probably underappreciated by a lot of investors. One more thing, if we think about living on, dividends, people are living longer, they're spending more time in retirement, so we have to think about inflation. This compares growth of the S&P 500 dividend per share versus CPI, which is the government's measure of inflation. So dividends per share from the S&P is the blue line, and inflation is the yellow line there. And you can see that over time, historically, dividends have always outpaced inflation. So if you have enough money to live on when you retire, as long as you don't inflate your lifestyle and spend a lot more, you should be taken care of the whole way through. Your income should grow more than inflation does, so you'd maintain your spending power. But we consider more than just dividends. This chart shows us dividend payments in yellow or in green down on the bottom there, and then stock buybacks are the purple bars on top, and then the red line is the S&P 500 index. So if you look back 2008, 2009, during kind of the great financial crisis, and then again, if you look at 2020 when COVID hit, you can see the buybacks kind of dip down. But if you look at the green dividend bars, you can see they're pretty steady. So that's that stability from the dividend payments that I was talking about. But companies are more and more turning to buybacks to return some capital to shareholders. And this does have some benefits. It's a little more tax efficient if you're holding these companies in a taxable account. But it also gives the company some flexibility, which I like. Your managers of the companies that you own should know the company the best. And buybacks give them the ability to say, this stock price is really undervalued. We're gonna spend some money on buybacks and generate some shareholder value. And it also lets them hold back when the market's overvaluing the stock. It gives them flexibility to grow if a good opportunity comes up, or if there's an issue they need to take care of. They can dial back the buybacks a little bit. So, it has some benefits, and it's another way companies are returning capital to shareholders. So I think we need to take that into account. And if we move on, this gets us to shareholder yield. So most definitions of shareholder yield are your dividend payment plus your buyback yield, and most include debt pay down as well, which I think also makes sense. If you think about your own budget, if you have high debt, say credit card debt or something with a high interest rate, if you pay that down, then that means that you owe, whoever loans you the money less each month. So you get to keep more. A company, it works the same way. If they have less debt, that means higher earnings. That means more money they can give back to shareholders in buybacks and dividends. They can grow with it, whatever. So if we combine those three things together, we get shareholder yield. And you can see that shareholder yield performs even better than just dividends alone. So all the way at the bottom of this slide is the S&P 500. All the way at the top are the highest quality shareholder yield companies. And that green line just above the S&P 500, those are your high dividend yielders. And in the middle is your top 10% by shareholder yield. So again, this makes intuitive sense, kind of going back to Joel Greenblatt. The companies that return the most capital to shareholders are probably going to perform better than companies that don't.
Okay, perfect. Thank you, TJ. So it's a strategy that works, dividend investing for sure. I see in the Q&A that Daniel already asked a great question. Joel, Jeff. So feel free to ask your questions there, and we will go over them in the end. So now we discussed what is quality investing, what is dividend investing, the performance of quality investing, performance of dividend investing. So now it's, if you are convinced about that those are interesting strategies, the next question you might have is, how can I select those companies? Well, if you look for quality stocks, those are always the same characteristics that you are looking for. So we are looking for a company with a moat, the most essential, but also skin in the game, low capital intensity. Question in the Q&A about capital intensity. We will talk about that later as well. Great capital allocation. I would say together with the moat, that's the most important thing for quality investors. So you want a moat in combination with great capital allocation skills. And when you have that, well, that's the golden goose for quality investors. That's what you want to find. But also the high profitability, fifth point, and a great secular trend or attractive growth are really interesting. But yeah, I'm not sure, and you can use the chat function if you want to, if many people, and you can take a guess, know how many listed companies there are in the world. And maybe let's play a game, and the first one, or the person who has the first one to give a correct answer, or is the closest, well, he can win something, or we can give him something special. Let's see. Oh, and I think someone has already seen a webinar or is very smart, because the first answer that has been given is the correct one. So Fostas says 60K. Lean also. So exactly, it's 60K. So Fostas, feel free to send an email and we'll try something. But for those 60K, I think 60K listed stocks, I think we can all agree that it's just impossible to analyze them all. So that's why we are using a stock screener to try and remove all the weeds or the bad companies and remain with all the flowers or the great companies. So first, quantitatively, we are screening for great quality stocks. And we do that by using those criteria. So we are looking for companies with a healthy balance sheet, so net debt on EBITDA. We want attractive growth or the secular trend, revenue growth higher than 7%, earnings growth higher than 9%. Capital allocation skills, that's measured by the return on invested capital, higher than 15%. Profit margin, higher than 10%. And you also want most net income to be translated into cash flow. And when you use those metrics, and we do that in FinChat, you will see that 200 companies remain. And those 200 companies are all great companies. 200 companies, it's already way more realistic to analyze them compared to 60,000 companies. And rationally seen in the long term, on average, those companies should be able to outperform the market because they are fundamentally healthier companies. And that's how we are going to create our investable universe. And then over time, also our portfolio. So your investment approach looks a bit like a funnel, which you can also see here. You start with all the companies that are out there. Then you use the quantitative criteria. A lot of the companies fall out of the buckets. They are the weeds or the bad companies. You only want to invest in the companies that you understand, so within your circle of competence. And once again, maybe 50% of all the companies fall out. And then you're going to do your homework, and that's how you're going to build a portfolio of 15 to 25 stocks that hopefully outperform the market. So that's a bit your working methods for quality stocks. And yeah, curious to find out how it's for dividend stocks, TJ.
Yeah, so we think about buying a local business and buying a publicly traded company as exactly the same. We think of stocks as ownership. And that goes back, Warren Buffett has talked about this, Ben Graham. This is kind of the fundamental idea behind good investing, as far as I'm concerned. So we're going to look at the operating and profit history. We want to make sure it's a business that's likely to do well in the future. I'm lazy, so I don't want to run the business. So I want good management in there. And as Pieter said, that means good capital allocation skills. Even though we're dividend investors, we don't want them paying everything back out to us. We want them taking care of the business first. And then once we find something that meets all of those criteria, we want to price it based on how much cash we can get out over time, because this is something we're going to own and be a part of for a long time. So, You can see over there on the right, I have a picture of a car wash. And that's a business that you could maybe think about owning. That seems like that might be something attractive to me. And, I wouldn't pay a massive price for a car wash or, base it on what the last person paid. I would look at what does that car wash earn on a regular year. And then I would start to think about, how much cash can I take out and still grow the car wash? And how long is it going to take for me to get my capital back and return on this, because I'm going to own this for a long time. So that's how we think about a public company as well. And we kind of have a little bit of an advantage over the quality investors in that there are pre-made lists of dividend growth companies. One of the more famous ones is the Dividend Aristocrats. And you can find these online. We've given them away as spreadsheets on compounding dividends. And here's the criteria. So they have to be a member of the S&P 500. They need at least 25 consecutive years of dividend increases, and they need a market cap of at least 3 billion. Some lists vary that a little bit, but in general, that's what it is. And the even more exclusive list is the Dividend Kings. These have increased dividends for at least 50 years. You can see a picture of some of them over there on the right. They don't have a requirement for market capitalization or index membership, meaning they can be found anywhere in the market. But if you look, a lot of those are probably pretty recognizable to you there. Target, Coca-Cola, Johnson & Johnson, Procter & Gamble, Altria. These are well-known, established companies. It's a pretty exclusive list. There's a few less known. So the Dividend Champions, the only requirement for that list is 25 consecutive years of dividend growth. That's an interesting list, I think, because there's no requirement for index membership and there's no market cap requirement there. So there are some more smaller and mid-cap companies in here that maybe aren't as well known as the Aristocrats, but still have that 25-year history of dividend increases. And then below that, there's the Dividend Contenders, and that's companies that have raised their dividends for at least 10 up to 24 years. And at that point, they move up to the Dividend Champions list. Same thing, no requirements for index membership, no market cap, no liquidity requirements. So you get some interesting kind of small mid-cap companies in here that may be less known. But we can also screen, just like Pieter showed, for the quality companies. And if we think about really what we want to generate regular income, and we want to grow that income over time. So we need companies, first of all, that can survive for a long time, so they keep growing that income for us. And then second, we need that growth to happen. So here is the qualities that we look for when we think about those two things. So for survival, we want to see low debt. That's one of those things, if a company has too much debt, the interest payments are too high, a bad year, a recession, something like a global pandemic could kind of put that company into trouble. We want a payout ratio that isn't too high. So like I said, even though we like the dividends, we don't want the company paying out all of the earnings to us. And we want to see a history of dividend payments. So that shows us that they've survived, they've had the ability to survive and grow in the past. And then for growth, we're really looking at growth of the underlying business because that's what's going to generate the dividends for us. So we want to see growth in both revenue and earnings. We would prefer to have a relatively high starting dividend yield. If you go back to that slide about the S&P and the dividend reinvestment, like I said, the S&P does not historically have a high dividend yield. So if we can start higher than the S&P, that compounding will work for us even better. We want to see a history of attractive dividend growth. Again, that shows us that profit has grown and the business has done well. And then, like Pieter, we have a preference for companies in an attractive market or with secular tailwinds. We tend not to want to, invest in things that are declining. So here's an example screen that I set up. Debt to equity, we're below 50, payout ratio less than 60%. The dividend yield we set at about 1.5%. That's roughly equal to where the S&P is. We would like to see 8% dividend growth, and for revenue growth, I set it at 4%, so we know that the company is at least beating inflation. So I kept it relatively simple, and you can see we get a list of pretty attractive companies. Actually, if you go down through this list, L'Oreal was on there, Accenture PLC is a good one. EOG Resources is one that a lot of dividend investors like. Some recognizable high quality companies on this list as well. So I think that brings us to where we'll give you a few interesting stocks. I don't know the order. I think Pieter might go first. You're muted, Pieter.
That would be fun, right? So the first one I brought for you, and then the next one is for TJ, is MSCI. So MSCI is a company that might ring a bell for a lot of you. So it's a data and index provider. And why I think it's so interesting right now is, by the way, and this is also a great example. MSCI is also buying back a lot of shares. So the shareholder yield is high. So this is also a great example of the combination of quality and dividends, and sometimes they are intertwined. And it's funny because TJ can also say that sometimes we are looking at the same stocks, like Zoetis, like Novo Nordisk, and so on. But anyway, back to MSCI. Well, MSCI is a great company. Why? Because they are benefiting massively from the rise of passive investing. And how do they do that? Well, every ETF that there is worldwide that has the name MSCI in it, like the MSCI iShares MSCI World Index, for example. Well, iShares is a part of BlackRock, and for every dollar or every euro that is invested in that ETF, BlackRock needs to pay money to MSCI. In other words, they are benefiting massively from the rise of passive investing. It's still a founder-led business. It ticks all the boxes, or checks all the boxes regarding quality. And one of the beautiful things about stocks like this is that when the assets under management are still rising because more investors are using it, and you have exposure to the stock market, well, then you are mathematically certain that you will outperform the market in the long term. It's just basic math, and that's what we have right here. So also when we look at the expected return on a model right now, well, 11% is what you get. So that's an interesting return if you ask me. So MSCI is the first example I brought for you guys. And now it's up to you, TJ.
Yeah, so in the financial area, I brought CME Group. You may or may not be familiar with them, but they are the world's leading derivatives marketplace. So these guys operate the exchanges for things like futures, options, interest rate products, interest rate swaps happen here, and they have a strong competitive moat due to their network effects. The other interesting thing about CME being the biggest is that they also can be the lowest cost provider. And they do something interesting. There are individual investors trading options and trading futures on CME, but this is also where a lot of the big asset managers and the investment banks hedge their portfolios. So you can think about, they're buying things like puts on the S&P to hedge the portfolio if the market goes down or whatever. And they may have multiple portfolios, and they may have multiple products that they're trading. And if you've ever traded derivatives or know anything about it, then you need to have a certain amount of assets in your account that back up those options or futures or whatever you're trading. What CME does is they allow these big companies, these big asset managers, to combine all of their kind of assets and accounts together, as well as all of their products. So that means that these guys can kind of have more leverage on their portfolios. It allows them to have lower costs, and it's really a strong advantage that they have. The other thing, these guys benefit from market volatility, from changes in interest rates, either up or down. And they're also benefiting kind of from the trend of individual investors using things like options and futures. They've partnered with Robinhood to offer options and that kind of thing to individual investors. So every single month they release trading volume, and it's been going up every single month for a long time. And we think that over a long time we're going to do very well with them. The expected return, the way we calculate it, it's above 14%. Historically, we really like their capital allocation. So they pay kind of a lower base dividend. Historically, they've paid out a variable dividend at the end of the year. But management is increasingly using some of that money to also fuel buybacks. So it looks like the company kind of agrees with us that the shares have been attractively valued and that owning them is worth the while endeavor. Let's see what Pieter brought next.
Yeah, next example. That's a great example because it's funny. Because all of a sudden, TJ brought up to me a few weeks ago, well, I'm considering buying Novo Nordisk. What do you think? And I replied to him, well, I'm considering buying Novo Nordisk too. So that's an example how dividend growth and quality can go together. And I saw an interesting question about the reinvestment opportunities for quality as well. So maybe let's dive into that afterwards. But Novo Nordisk is a great example of a quality stock that has been hammered lately. So it's down 50% from its peak. But I think that it's completely unjustified and that everyone right now seems to agree that Eli Lilly will dominate the entire market for obesitas and diabetes. But Novo Nordisk is still relevant too, and they have been around for 100 years. And I don't think this will change anytime soon. So the expectations implied in the current stock price right now are very low. And this while the market for obesitas, the market for diabetes will grow at very tremendous rates. So if we look at the outlook for this year, for example, Novo Nordisk will grow only by 15%, which is still amazing given the fact that it's trading at one of the lowest valuation levels over the past 10 years. And that's also what you see at the expected return. So you see an expected return of 17.7% per year. That would mean that the stock would double more or less every 4 years. And obviously, when that would be true, I think, that would be very satisfactory for long-term investors like ourselves.
All right, so kind of also in the medical space, Zoetis. So they're the global leader in animal health. They do vaccines and medicines for pets, for livestock. We really like them. We think there's a real long-term trend of pet humanization here. So people are more and more treating their pets like family. You see a lot in the news about kind of loneliness, and people are getting pets to deal with that. I know we have a dog, and I'm not sure if he thinks that he's a human or if he thinks that we're odd-looking dogs, but he really thinks that he's part of the family, and we pretty well treat him that way as well. And I don't think we're unusual in that. So this is a high margin business with really strong pricing power. Again, when we look at our expected return, it's over 10% a year.
Okay, great. If we go to the last example, our last example for me and for TJ as well, Judges Scientific. So you see a picture of, on the right-hand side, the beautiful looking guy, CEO and founder of Judges Scientific, David Cicurel, and on the left-hand side, the less beautifully looking guy, myself, but I'm trying, right? But Judges Scientific is another company that is definitely quality. It's a serial acquirer in healthcare instruments. So you can see it a little bit like the Thermo Fisher or Danaher, but then on a lower scale or on a smaller scale. And that's really interesting as well, because the smaller you are, the more attractive it is to grow at very attractive rates. So I met David Cicurel after the AGM in Omaha of Berkshire Hathaway. And it's a company that has gone up 100x since 2005. So we're doing tremendously well. And I don't see any reason why that would stop anytime soon. So also in our model, we see an expected return of 12.4% per year. And this is a beautiful example of a small cap in our portfolio, or small cap, mid cap, that did really well. And I was discussing with TJ as well just before we went live. Some people might have seen it. So this afternoon, we launched a short investment case about Computer Modeling Group. And let me check right now. Well, it's becoming an issue because Computer Modeling Group is up 6.3% today, just based on the investment case, which is ridiculous. So that also means that They're 36 million in extra market cap because of the investment case. So that's becoming an issue for compounding quality. But it's also the market is way less efficient in the small cap space. So it's definitely a space we want to keep looking, because Warren Buffett said, well, go where competition is weak. Competition is way weaker in the small cap space, and Judges Scientific is a perfect example from that. And then I hope you are not a user of your next pick, TJ, but let's see what you brought.
Yes, I'm breaking the trend. We both did financial companies, then we both did healthcare companies. You did one that helps with healthcare and life science, and I did cigarettes. So my last company, this is British American Tobacco, and I am not a user, but every time I'm in line at the gas station or convenience store and a user is ahead of me and buying cigarettes, I'm amazed at what they'll pay. And I'll come back to that and talk about that in a second. But British American Tobacco, it's one of the world's largest tobacco companies. So the brands Dunhill, Lucky Strike, VUSE is their vape brand. This is an example of a high yield company that we like. So not all of our companies necessarily are dividend growers. We really focus there. But if we can find an attractive high yielder, we don't mind adding them to the portfolio either. And the reason we like British American Tobacco is that it's a very cash generative business, and they're very focused on that dividend. That's the reason a lot of investors buy them. And I said earlier, we don't like to invest in, trending down industries, dying industries. People tend to think of tobacco as that. It's really not. Worldwide, if we look, it's fairly stable, or use is growing. But the thing that we really like about British American Tobacco is that it's transitioning into reduced risk products like vapes. They have what they call their modern oral tobacco segment. So that's like the little tobacco pouches. And that's all combined in one company. So if we look at the cigarette industry as a whole, basically what's happening is, even though sales of cigarettes are declining in volume, the tobacco companies have been able to raise price continuously to make up for that. And then if we look overall at some of these reduced risk products like your vapes, your modern oral products, there's what they call heated tobacco products where they're not actually burning the tobacco. Those are growing at a significant rate. And like I said, British American Tobacco combines both. So I mentioned Altria earlier as a dividend king. If you look at Altria, it's basically just the tobacco products. So it's your traditional cigarettes and oral chewing tobacco. And years ago, Philip Morris International was split off from Altria, and Philip Morris now contains a lot of those reduced risk vape, modern oral type products for that group. And Philip Morris is doing much better than Altria. Like I said, we picked British American Tobacco. It was trading at a really attractive valuation. We bought it. We get both of those businesses together, and we think, again, we're going to do really well. We expect somewhere around a 13% return per year out of British American Tobacco. And just to give you some perspective, right now our yield on cost is almost 10%. So there's really not a lot of growth priced into that earnings growth model. We don't need British American Tobacco to do anything heroic to really give us a nice return.
Okay, perfect. And now we've arrived to the last end of the presentation. That's just a special gift for you, or at least we will try. So I think TJ is doing an amazing job at compounding dividends, and Willem as well, who is also involved, made a beautiful overview about everything that you get with compounding dividends. So you get the deep dives of the portfolio. You get the portfolio itself, obviously, so you get an insight about every stock that is in the portfolio, why we think it's interesting, how much dividend it's paying, how the dividend could evolve. And I think that's a beautiful thing, as TJ mainly also does an excellent job in identifying the dividend growers. Well, as long as you keep them long enough, you probably will get a yield on cost of 10% over time. It might take a while, but it means, and with the yield and cost, it means if you buy a stock for $10,000, that over time, every single year, you get at least $1,000 in dividends. So I think that's a great objective, and that's beautiful thing about those dividend growth stocks. No matter what happens to the stock price, if the dividend keeps the same or it increases, well, you get your monthly income every single time. And for the rest, you don't need to worry about the stock market fluctuations. And the great news is, of those dividend growers, over time, despite the volatility, those stocks will go up. So you get the deep dives, portfolio. We are working on courses, one pagers, an ETF portfolio, daily news reports, and so on, which is a lot of fun. So there is a lot of value in there, I think. So you see the same here with a little overview about everything we offer. And what we try to do is very simple. We try to provide you with as much value as you possibly can, and that in exchange for a subscription fee. And your question might be, in that case, what's your subscription fee? The sad news is we are expensive, guys. So usually when you have the founding tier, that's 1,200 USD. But we are also, obviously, that's expensive, and that's also why we are trying to do something special for people. Well, we appreciate it today, for example, that you are here. If you live in Europe, it's a very warm day today. In the US, it might be as well, and it's in the afternoon. So we appreciate that you are taking some time off. So that's also why, and we did something similar with Compounding Quality in the past. If you use, or if you subscribe today, that you can also get the founding subscription for the price of the regular subscription. So that's $499 a year instead of $1,200, which makes it already better. But it only becomes better in the sense that, well, on top of that, there is a 20% discount. So you'll make it $399. But the lovely thing as well is, I always say that, and TJ says it as well. Well, we are very convinced that we can create a lot of value and that we are doing the right thing. And the goal is there that $399 is the subscription price right now. But if you invest 10,000 or a bit more, the goal should be that you generate way more than $399 per year in dividend income, and hopefully over time, $3,999 for a compounding dividend portfolio right now. It's almost 10,000 a year. So it would be lovely to generate a portfolio that generates so much dividend that you can just live from that and generate 5,000 a month in dividend income, for example. And we are so comfortable about that we are doing what we are doing. That's right. That's also why we are just giving a 90-day money back guarantee. So if you want to test it, if you want to try compounding dividends, if you want to see what TJ got, you can use the QR code today. Subscribe to Compounding Dividends, and if you don't like what you get, well, just let us know and we refund you the money, and there are no questions asked. So it's basically a risk-free trial you can take on Compounding Dividends today if you want to. So you can always reach out to TJ or me. Well, it's TJ at compoundingquality.net, or Pieter, my first name, at compoundingquality.net, and we will just receive the email. Or if you just receive to any email you receive from Compounding Dividends, Compounding Quality, or Dutch version, the kwaliteitsbelegger, it will arrive to us. So it would be lovely to get some extra love in the Compounding Dividends field as well, and start there. I see Rakesh asked the question. Well, I'm already subscribed. Welcome, Rakesh. If I buy today, will my existing subscription extend by 1 more year? Yeah, I think we can do that. So you can definitely use it. It might be the case that it doesn't work, but send me an email in that case, and we will arrange it, and I will also get the specific benefits for you. There are some questions, TJ. So I will maybe operate as a moderator for this time and try to ask one. Well, I think there's one question, because you briefly mentioned that from Purus. Well, if you look at, for example, at Altria, they have quite a high dividend yield, but how do you look at the quality of the dividend yield, and how do you know whether it's sustainable and they can keep paying the high dividend, or whether they can't?
Yeah, so a couple things, and this isn't specific to Altria. This is just kind of the framework that we would use and how we think about it. So a couple things we would look at. One is the payout ratio. I don't know Altria's at the moment, but for a high yielding stock and something that's not growing quickly, like an Altria or a British American Tobacco, we do allow a little bit higher payout ratio. We really want to look at kind of the debt profile of that type of company to make sure that they're not going to get in trouble that way. And then really where we're going to look is we're going to look at the underlying business. So how is the dividend growth comparing to, say, earnings or free cash flow growth? So if they're paying out, a high dividend, maybe the payout ratio is 70, 80%, and the dividend's been growing, let's say 4% a year. If the underlying business is growing at least that 4% a year and has been, then that payout ratio is going to stay the same. And as long as we don't see anything coming up that's really going to disrupt the business, then that dividend's probably okay. Now, if you see, 10% dividend growth on 4% earnings growth, you can do the math, and either that business is going to have to grow a lot more in the future, pick up the growth, or the dividend growth rate's going to have to slow down, or if it gets, into too much trouble, that dividend is probably looking to be cut. So we really think of it again like a business owner. Is the business growing, and can we keep taking growing profits out of that business, or is our business stagnant, or is it declining? And that's a sign of trouble.
Okay, perfect. Thank you, TJ. Someone is also asking, can you offer a global price for all products, for example, compounding quality and compounding dividends? Yeah, feel free to send me an email and we can figure that out. Another question I just saw, yeah, I will start a live answer. So Geert is asking, well, how many stocks do you have in the compounding dividends portfolio right now? Do you have a specific preference? And maybe also, as the portfolio is still in the build-up phase, well, how many stocks do you want to own eventually, TJ?
Yeah, I believe there's 8 right now. Eventually, the goal is probably somewhere between 15 and 20 stocks. We kind of look at that as, the right amount of diversification. Once you get out beyond that, really, you're at the same risk as the market. And we think that we can find 15 or 20 high quality dividend paying stocks. If we try and find too many, that becomes a really difficult problem because there's not that many companies that are going to meet our criteria that are also going to be available at an attractive price. And if we make it, too few companies, we do want some kind of diversification because, we're going to be wrong. Investing's really, really a hard thing. Peter, I know you've talked about Francois Rochon's rule of 3, that 1 out of 3, decisions we make is going to be a mistake. So in that 15 to 20, we can afford to make 2 or 3 mistakes. And as long as 2 or 3 companies do really well, we're going to do fine. But, if we had 2 or 3 companies in the portfolio, 1 or 2 mistakes is a big deal, especially when we think about the goal of having that growing stable income stream. So ultimately, hopefully, we settle somewhere in that 15 to 20 range. But as you said, we're still building up the portfolio.
Okay, perfect. Thank you, TJ. A question from Daniel. I will start a live or the answer again. So what he's asking, well, we briefly mentioned low capital intensity. Well, isn't the backside or the other side of low capital intensity that there is low barriers to entry? I understand that brand has value, but in this new world, well, it seems to be that the moat is slowing down and new brands appear on a daily basis. Well, do you want to take this one, TJ? Do you want me to take it?
Honestly, that's something I think maybe it might be interesting for us both to give kind of a
Yeah,
brief
sure.
answer, because I think that applies to both, really, Peter.
Exactly.
So I can talk about it since I'm already talking, and then you can
Yeah, go
collect your
ahead.
thoughts and give them to us. I think it really depends on the company, but I do understand the question. And interestingly enough, this is something that I have been thinking about quite a bit recently. You are correct that low capital intensity can mean low barriers to entry. You think about software and app companies, for example, with AI. It's very easy for someone to have AI help them out with coding or to write an app. There's all kind of no code tools out there. So I think you really need to think about and understand the business. And I have been wondering lately, and I don't have a good answer at this point. I have been wondering lately if some of those more capital intensive businesses are possibly being underpriced by investors and that the moat there is possibly underappreciated. So I think that kind of going the opposite direction, that capital light idea is really popular right now. Investors tend to be looking for it. I tend to have a pretty contrarian streak in me, so it's attractive to me to look elsewhere. So that is something I've been thinking a lot about. Like I said, I don't have a great answer, but I will throw in also that some of the formerly capital light businesses no longer are. So we think about things like Google, Facebook, some of those large tech companies. They're investing a lot of capex into data centers, AI, that kind of thing at this point. So that's kind of where my head is on that. Peter, do you have any different thoughts or anything to add?
No, I think you gave an excellent answer. I don't think I have too much to add. As Charlie Munger would say, I have nothing to add. But I think it all depends. I think you need to have the low capital intensity is important, but what's also crucial is that you combine it with the modes. Because when you combine the low capital intensity with a mode, well, you have two factors that make it very, very hard for other competitors to enter that market. I think, for example, like you mentioned, TJ, a lot of the big tech companies were very low capital intensity. Right now, they're investing a lot, everything related to AI and so on. But you have a lot of companies like Games Workshop in a very niche market, for example. They are not capital intensive. Every single year, they increase their prices. And other companies know that, but just because they are so strong, it's just impossible for other companies to take away the market leading position. So I don't worry about, in general, that companies with a low capital intensity, it's easier for other competitors to enter there. So I think it's actually a great thing and a must for investors. We're already running out of time, so maybe one last one for you, TJ. Well, it's a question from someone who might become or want to be anonymous, but he asked, well, is it possible for you to create a dividend portfolio where you generate monthly dividend income, where you receive dividend income every single month?
It is possible, yeah. So there are some companies that pay a dividend every single month. Realty Income is probably the best known one. They actually use that as their tagline. I think they call themselves the monthly dividend company or the monthly dividend payer. But there is a group that do pay every single month. But if you don't want to limit yourself to that specific list, generally, especially in the US, companies pay on a quarterly basis. But not every company runs their quarter on the exact same month. So if you look at kind of what the payout history has been, you can build a portfolio where certain companies pay you in January, and then certain companies pay you in February, and certain companies pay you in March. And by the time April comes around, that company or those companies that paid you in January are now paying the April dividends. So as long as you stagger kind of the quarter, the month that those companies start the quarter on, you can, if you want to, create your own kind of synthetic monthly dividend paying portfolio.
Okay, perfect. This was a lot of fun. So hopefully everyone enjoyed it. I want to sincerely thank you, TJ, but also everyone attending on this lovely day. And hopefully you learned something new. We can see you at Compounding Dividends. And then we will get in touch soon. So have a lovely afternoon for those in the US, lovely evening for those in Europe. And we talk soon. Bye-bye.